A high cap rate means it's a less desirable asset. So a high cap rate means for that same $80,000 of cash flow, maybe instead of paying $1 million for it, you're only going to pay $800,000 for it. So the cap rate goes from 8 to 10 in that scenario because people are willing to pay less for it.
Hi, everybody. David and Drew with Nighthawk Equity here. Cap rate. Let's talk about cap rate. It's a very important metric to understand when evaluating a real estate investment. So let's break down what cap rate really means. Drew, take it away.
Yeah, thanks, David. So the cap rate, as you said, very important number discussed a lot in our industry. And it's basically a measurement of the cash flow that a property generates for its ownership prior to any debt on the property. So it's a measurement of the operations of the property. So if you bought it for $1 million and it produces $80,000 a year of cash flow, you just take that 80,000, put it over $1 million, and you have an 8% cap rate. And so that very simply on a mathematical level is what a cap rate is.
All right. So putting it into terms that people can understand. So how can your average investor interpret what this means for their investment? What is considered a good cap rate for multifamily investments?
I have a little bit of a trick answer to that question, but I'll answer it first. So a low cap rate corresponds with an asset that's highly desirable. So a low cap rate might be in high-end markets like New York or Miami, markets that are growing really quickly, or markets where people are moving in there and there's a lot of demand for housing. So all those things are going to push up people's desire to buy the property. And by doing that, it's going to push down the cap rate, right? The price of the asset's going to go up. Inversely, a high cap rate means it's a less desirable asset. So a high cap rate means for that same $80,000 of cash flow, maybe instead of paying $1 million for it, you're only going to pay $800,000 for it. So the cap rate goes from 8 to 10 in that scenario because people are willing to pay less for it. So there's an inverse relationship between the cap rate and the desirability of the asset. Now, you asked what a good cap rate is, and I think that's a little bit of a tough thing to answer. What I would say is that my best investments that I've ever done have often been ones that had like a 0 cap rate, a 1 cap rate. And the reason for that is because the cap rate is a historical looking data point. It's looking at the past performance. And in syndications and multifamily, what we're usually trying to do is find a property that has a problem, and then we're going to fix that problem. And if it has a problem, it usually isn't producing much cash flow. And so often that drives the historical numbers down. So for that reason, cap rate is something that we do look at, but we don't get too focused on it, because if the asset was performing perfectly, it wouldn't be a good purchase for us to buy as a syndication. So we look at cap rates as part of the situation, but we don't look at it as the entire explanation for how a property is performing.
All right, guys. Well, there you have it. Thanks so much, Drew. If you're interested in learning a little bit more about these types of terms or anything related to passive investing, feel free to book a call with me. You can do that by visiting nighthawkequity.com/call. And I would love the opportunity to speak with you. We'll catch you on the next episode. Thanks so much for tuning in.